This morning, we're talking about results from CNBC's latest Delivering Alpha investor survey. It brings together the market intelligence of the nation's leading institutional investors, top strategists, and our own CNBC contributors. 61% of those polled said we've entered a new bull market. The other 39% said we are currently in a bear market rally. For more, let's bring in David Bianco, DWS Group America's CIO. David, great to have you with us.
Good morning.
What do you think? Where do you fall in that survey?
Well, I'm still cautious. I've been cautious all year. But it does look like it's been a great start of the year. Looks like the equity market's trying to start the fireworks early. It's been a great half. We might get to year highs for the year. I think that will depend on the inflation report at 8:30. But the market's doing well. I would argue that the challenges are still ahead. The Fed has not landed this plane. It needs to point the nose down more, because one of the things that's happening here is this wealth effect from the equity market is keeping spending power strong. And the equity market's going to make the Fed's job a lot more challenging.
The equity market and also the housing market.
Yeah.
Prices remain fairly resilient here. And so you got to wonder, I mean, if Jerome Powell was looking for a reset in the housing market, he's not getting it there, and he's not getting any help from the equity markets either.
The data does not suggest that they're done hiking, and the data would suggest that there's more than one hike probably to go.
Which we know. Right.
We know there's at least one. I think that's
at least two. I mean, most are in favor of at least two.
And I'm beginning, and some of the investors I speak to are beginning to seriously consider three, and that there's hiking going on for the rest of the year. Why? As you said, housing, which is supposed to be very sensitive to interest rates, new housing starts at least are still very strong. Labor market's rock solid. Economy is buoyant, not growing robustly, but not recession, not yet. And now you've got this equity market. And let me make this point. It's not a valuation point. It's a wealth effect point. The U.S. equity market is 160% of U.S. GDP. 40-plus years ago, the last time we had this kind of inflation problem, it was not even 40% of U.S. GDP. So the wealth effect out of equities is 4 times as much as it was back then. The Fed has to keep an eye on this equity market as part of its navigation.
We have a decent roadmap of where the Fed is going to go in the sort of the side effects that at least two hikes will have, and higher for longer will have. And yet we are still at these valuations. One could argue, if you are a bull, that we've taken all of that into account and that we are still at these levels.
Yeah, and markets are smart, but the S&P's 20 times this year's earnings. I don't see a whole lot of upside to the about $220 of earnings I'm estimating for this year. Tech sector's 30 times earnings. Certain big companies in the tech sector that traded for 15 times earnings over the past 15, 20 years while delivering terrific growth, they're at valuations that are 30 times that. Why are these valuations so high when interest rates are presenting a very fair and solid alternative? I think there's a lot of liquidity out there, and the Fed needs to do something about that.
Has your view changed at all, or do you think it will change if we see a continued steep climb in the 2-year yield?
Well, that has been not just an indication of where investors think the Fed's going to go, but perhaps the least risky opportunity as an alternative, short-term Treasury bills. You can make well over 5% over the next year or two, 18 months in Treasury bills. I think you would want to make 3 times or maybe 4 times that in the equity market over the coming year to not take that riskless opportunity. I don't think the equity market has a great second half. I think the challenges that we've been talking about for a long time are still with us.
You should get out of the business if you want to stay somewhere for 2 years for 5% a year. You can't do better than that. You can't figure out some stock.
I didn't say that we can't.
You can't find a stock
better than that.
My friend who's still in the business says, "You have a nightlight? Do you sleep with a nightlight on?" I mean, you can't find an opportunity in the stock market that's going to give you better. You put 10 grand and 5%, you get $500 at the end of a year.
Think about how difficult it is.
You own any Bitcoin?
Think about how difficult it is. No.
It's at 31,000. It was
80%.
It's at 17,000.
Think about how difficult it has been to beat those tech titans over the past year, several years, and decade. So that's the nature of the equity market. Do you really believe that there's more valuation and super earnings?
But then when you're done, the Fed's going to be cutting rates, so your 5%er is going to come due, and you're going to be looking at 3%.
Maybe 3.5, and I think the 10-year Treasury yield might be.
Did you ever say buy in the last year of the stock market, David?
No, not this year.
So we missed the rally.
Yes, we missed this rally.
When would you say? Now you can't say it.
I don't think now would be a good time to chase. No.
Yeah, okay, but that doesn't help anyone that listened to you for the
we'll
last
point
year.
out what we prefer. We like healthcare, and we like big banks and insurance companies, which are benefiting tremendously from this. Now, many investors have refused to look at foreign stocks, both Europe and Japan. That's an alternative.
Don't you wish you had bought? You could have bought the QQQs. I mean, don't you wish you had bought a net?
We wish
35%.
We do own these things. We are at this, and we've been overweight those things most of the past handful of years and longer. Year to date, underweight portfolios I manage, underweight big cap tech. Yep, I'm crying a little bit about it, but I wouldn't change it.
In sectors that have lagged. I mean, financials are down for the first half of the year. Healthcare is up single digits for the first half of the year.
It's not about what's happened, it's about what we expect from here, and it's been a great year for big cap tech. We did see in June some other broadening of the equity market.
But you would expect clients to listen to you now, even though the last year was not a good idea.
Clients listen to the strength of the arguments, and the arguments are valuation does matter.
That in a quarter will get you. That won't get you a cup of coffee, but the strength of the arguments. Is that what you tell your clients? Hey, I had some great arguments. Sorry about that 35%.
Right. Let's see the inflation data at 8:30. I think that will determine whether we do hit a new high for year to date. But I would be careful in the big cap tech space. Look for some alternatives.